Hey everyone, hopefully having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. Let's dive right in, take a look, see what people are sharing. If you want to follow me at _finance, and if you want to join our community, finding-value.com, we've got a question and answer session coming up Saturday, 7 a.m. Mountain Time. I'm going to go over a few questions there. Someone had asked the question, and again, I probably have gone over this before. What is my approach to selecting individual companies or stocks? So that's something that we will attack in the beginning of that Q&A session. And if that's something that you're interested in, you will get what I think are my insights of what my approach is to finding companies in different sectors. We do have a coupon code. Special is the coupon code. You get 50% off the monthly membership for just the first month and a larger discount on the yearly membership if anyone wants to either switch to the yearly membership or sign up directly to it. Those are options, and we've got that Saturday call. There's the most ridiculous energy bull market ever, which I agree with. I love this, guys. This is exactly how I view it. He says, I totally agree. I think this is why the setup in oil looks so explosive right now, because this is the beginning. This is beginning to be discounted. Positioning in the oil and gas space has been completely wiped out, and we've talked about how the policy price volatility has created a dearth of investment that will ultimately lead to a price shock in the next couple of years. I agree. 20-year base looks close to completion and ready to rocket. Nobody positioned for this right now. Not even oil and gas executives see 100 plus WTIC in the next 2 years, let alone a trip above all-time highs of 2008. This would shock everyone. Look at this technical setup here, guys. Now, I'll describe what I see in the technical setup, and let me open this up real quick to get to that technical setup there of what I see for U.S. oil. So this is what he has. He's got these falling wedges in the corners there. I love the falling wedge. Don't get me wrong. I really like falling wedges. He's got another one there, breakout, another one here, breakout, and another falling wedge that we're in the corner here. We've got a bear trap. I call that the slingshot cheetah. This is where we get a washout of everyone when it comes to the corner. That washout also occurred in 2001, which is right here. That washout. So this fractal is the same fractal as this one here. The reason I can say that is because of what preceded it. Fractals, just to let you guys know, are repeating patterns that happen at different time scales over and over. So a fractal is a pattern that repeats over and over on different time scales. So when I look at it and I look at US oil, I'm going to back out, put it on the lines, and go logarithmic. So this is how I view it. And I'm sure you guys, if you've listened long enough, have figured that out. So that circle is where the circle is right now. Now, I don't know if I'm at the bottom of this. We could still go down further, or do a double bottom. Tough to say. But what led up to it is a three-hump consolidation. Those are consolidations. Those 1, 2, 3s are consolidations. This three-hump consolidation, the three-hump consolidation, and that's called a fractal, the way that it moves. That's the extended psychology of the herd, of how humans trade together. We don't understand why these patterns are generated by the herd and how they're generated, but they exist, and they're pretty reliable. Now, what I think the fractal that we have now is the upward move. So we have a upward move, that's the move, and then I think that what we are going to do is that there, basically. Something on the lines of that. You can see that the fractal is very close in the way that it's constructed. So something on the lines of that will occur. We'll probably hit a little bit of resistance right underneath $140, $150 there, come back a little bit, and then rip through it. What this is called is wave 1, 2 is the pullback, 3, 4, and then 5 in Elliott wave form, we'll call it. This is what's coming. A way that we can see that is that gold's already exploded higher, and that this fractal that we've got here has repeated here, here, and now we are in that move. The reason I think we are in that move is a couple-fold. Gold's our leader. Gold's ripping like heck. Another thing is that the fractal is identical to these other moves. That's another thing. We also have the consolidation periods before it that are exactly the same. So the consolidations, the fractals, and everything look similar to history. Furthermore, we also have a very cheap ratio of oil to gold. So we have a long runway of valuation upward for this to move. We also have a variety of different things in terms of ratios. For instance, I could put a crude oil divided by gold ratio, and that is good for oil to outperform gold. You can see the 3-hump consolidation, breakout, 3-hump consolidation with a false breakout. This is called the slingshot at the bottom there. So I think oil is probably one of the best investments in the market in terms of opportunities. Obviously, there's other ones too, not just oil. There's uranium that's very good, and oil, and there's even more than that. And I go over all of those things on the website. And then I try to find the best individual companies to play this setup in the ratios. So if we get a big move higher, I will capitalize on that through a variety of companies that I think are the best way or vehicles to play this move going forward. And it's a variety of things. And you can also look at the fundamentals of oil too, low inventories, fair value based off dot plots of inventories is $95-ish, crude oil. You can also look at out in the future the difficulties of increasing production around the world. You can look at discoveries versus production, and we're using about 3 or 4 barrels to every 1 barrel we are finding today. That can't last forever. So eventually, I do think that we'll hit peak oil. Some people state that we've hit peak oil in 2018 already in terms of oil. We are now using natural gas and natural gas liquids to raise that production of that number. So there could be a lot of things also in this world that are effects, like our debt problem is a problem of energy growth potentially. It's could be one of the problems. And that could also have problems and ramifications to currencies in our system. So I agree with this guy. It looks fantastic, and I think it is a bear trap, and I think we're going to squeeze into a slingshot higher, just like these traps before in these red circles of every single time. So he's also seeing a confluence of information. Marlum says VLCC surge again in a pivotal week. Jeffries reports Eco VLCC earnings at $55,700 a day, fueled by cheaper Saudi crude, rising OPEC plus flows, and post-Easter fixture bunching. So that is another way to play oil is through the tankers, which I also cover. And the day rates have been pretty good now that these announcements of OPEC could be releasing some volume to the market. We'll see how much volume actually comes to the market. That's also something that we'll go over later here. And a reason, I do talk a lot about oil. I'm sure it comes off like Andy talks about oil. I think oil is the most important commodity in the world by a long shot. There's nothing that even comes close to it. It is a large driver of energy input into the world. It's also the number one commodity, and it's found in everything, absolutely everything. So oil, there's been 2 things that have been seen at the beginning of every commodity bull market almost. So if you look at these most recent commodity bull markets from 1970 onward, Those bull markets were spurred by two things. The first thing was an increase of credit coming into the system. So what that does is it strains the system. And what it strains is it strains the number one commodity. If the number one commodity has a supply problem, you get massive inflation. So in the 1970s, specifically 1970 itself, the year 1970, we hit peak oil in the year 1970, and that was the same time that credit was coming into the system through monetary bank lending uh, of of people buying homes. It was a larger demographic. It stressed oil and it pushed oil from a very low price to a ridiculously high price. We also saw precious metals rip during that time frame. So the big question is, and this aligns with credit expansion, is what people will say is commodities go up when the real estate cycle puts credit into the system. And I would say that is partially true, and it is 100% true looking backwards. Going forwards, though, I think that is also true if you were to apply the real estate cycle and then credit expansion from it. But I also think that you can have a gigantic commodity bull market without the real estate market driving it. And the reason I say that is if you get into a debt crisis where money keeps piling into the system and they can't stop it, that is also credit expansion. We call it fiscal spending. And that's your interest payment on the debt. And if you have a problem in oil, which is going to have to occur on a worldwide basis, if you have a problem in oil because that money coming into the system is going to stress oil. And if we have a problem in oil, I think we're going to see interest rates go up dramatically, just like the 1970s and other things. People will start to worry about the currency and the bond market. The bond market's already bottomed and are already topped and heading lower. Interest rates have bottomed and are heading higher. And I think at some point we're going to see bonds and stocks go down simultaneously at some point, and commodities and precious metals go way up. So that's what I think is going to come. And leading into this, so this is your buy assets. So why is it buy assets? Because a bunch of money is coming in 2025. See that green? That's all of the world loosening credit. That big green area on the right-hand side. So this is central bank liquidity heat map, end of March of 2025. See how it's all green? This was all red before, and that's the slowdown of inflation. This is going to be the speed up of inflation, and this is, think of it as M2 money supply or liquidity. This is going to stress oil again, and I think oil is completely off sides right now of where it's priced. Here is your global liquidity cycle in advance. You can see it's coming on up in terms of the cycle. Global liquidity cycle. So there's two kind of things here. It's the yield curve turning point plus 8 months after liquidity, and then the risk appetite turning points are 3 months before the economy. So then you can see how this thing cycles back and forth. The liquidity cycle and the economic cycle. Liquidity comes first, and there's so I call it an 18 to 24 month lag. He says 15 to 20 months. Could be around there. And that's the lag that liquidity comes and it hits the market. So it's when the beginning of this green starts, there's a 15 to 20 month lag for when this turns green. You can see it kind of changes right here. That's early 2024. We're probably 1 year in, and it's going to come 3 months later, 3 to 6 months later here is probably what we'll see. This liquidity hitting the economic cycle. And this is global liquidity and world wealth. You can see here that global liquidity is coming upward, and this will track it later with a 15 to 20 month lag. And that's why you see generally liquidity turns up, and then this will lag behind it to some degree, the black line, which is your all wealth, including gold and housing. This is Frank, and I wanted to read through this real quick. It says, this man just admitted the stock market is rigged. He says, Trump's Treasury pick revealed he secretly meets with the Fed weekly. He leaked exactly when they'll intervene to save the market. The payoff, 200% returns if you spot these 3 signals in the next 30 days. So Scott Bessent is the most important money man you've never heard of. He was Soros' right-hand guy, the guy who break hedge funds for fun. Now at Treasury Secretary, he's dropping hints about what's coming next. But his recent Bloomberg interview revealed something crucial. Here's what nobody's talking about. Bessent casually mentioned he has weekly breakfasts with Jerome Powell. Think about it. The Treasury Secretary and the independent Fed chair are meeting every damn week. This coordination signals something massive brewing beneath the surface. They're already doing off-run buybacks, buying Treasury bonds to inject liquidity. The Fed is slowing their balance sheet runoff. These are forms of quiet QE that nobody's paying attention to. But that's just the tip of the market manipulation iceberg. But here's the bombshell everyone's missed. Bessent said that the VIX has peaked at 60. In other words, he just told the world he believes the market bottom is in. That's not something government officials typically announce. The implications for your investment strategy are huge. And I agree with that. I read this too, of him coming out saying, I think the VIX has likely peaked. And Bessent revealed the exact trigger point for intervention. If the 10-year yield stays at 4.5% or higher for about 2 weeks, the Treasury will step in. The game is fixed, folks. This insider knowledge completely transforms how you should position. Make no mistake, Bessent knows what he's doing. This guy sees all the stress indicators long before they hit the news. He's not going to let the markets truly crash. And he's about to deploy the exact same playbook that made Soros billions of dollars. When asked about recent market turbulence, Bessent was dismissive. This just looks like somebody got over their skis, i.e. some hedge fund blew up, but we're not bailing them out. He's selective about who gets saved and who gets crushed. So what does this mean for you? It means don't panic, sell when everyone else is. The Fed and Treasury are coordinating behind the scenes and will not let markets truly crash. They'll intervene before things get truly ugly. The strategy that protects your wealth is surprisingly counterintuitive. Here are the signals to watch. The VIX approaching 60, the 10-year yield above 4.5%, the bond market liquidity deteriorating. Any of these will trigger the Fed Treasury response we're expecting. And when intervention comes, expect massive market surge. Whether it's formal quantitative easing or more runoff buybacks, when the Fed and Treasury act together, markets rip higher. That's why Bessent can confidently say the VIX has peaked. He controls the game. What should you do? Use market fear to your advantage. When the VIX spikes and everyone panics, that is your buying opportunity. Because Bessent and Powell are having breakfast, planning exactly when to step in and save the day. Insider mechanics like this are unmissable opportunities. I spent decades building relationships with hedge fund managers, former Fed officials, and major players in finance. They tell me what's really going on, not the polished narratives you get from the mainstream media. That's how I spotted Bessent's situation weeks ago. These insights have helped my subscribers navigate So I agree with that, though. If he does hold under 4.5%, that will hold the stock market up. But I think with the inflation coming into the system, they have to be careful because it's going to blow oil to the moon and gold. Gold's already front running that move. Gold front run the move. Oil's coming next. That money and liquidity that we saw, this green up here, that's going to push oil and commodities higher. And as money starts to rotate differently in the system, more money is going to start to leak into commodities. Trucking volume. So this is something that's counter to what they're doing. Just an FYI. Trucking volumes out of Los Angeles are equivalent to Thanksgiving and close to Christmas. Thanksgiving and Christmas are typically the lowest volume days of the year. Truckers should avoid freight to Southern California, else risk having deadhead back to Dallas to get loaded. Why is this so low? Well, it's that tariff. This could have an impact eventually on supply chains in goods. Like things could get pretty tight here if things are supplied by China. Just an FYI. So HFI Research, he's kind of throwing out the data here. He says plus 1 million barrels per day, they said. Big glut, they said. Well, where's the glut in inventory? There is none. There is none. This is total liquid stockpile with SPR low. The EIA total liquid stockpile low. We're not high. Where's this glut? We're trying to find it. And here is the demand supply balance. They say that we've got all of this oil coming out in the future here. That's what they are projecting. Well, if this is coming, let's see it in inventories. We should start to build inventories, but we are drawing inventories massively right now. So something's got to give here. It says the biggest oil glut since COVID, and here we are running down product storage to low levels of inventory for gasoline, distillate, and jet fuel. Where is this glut? Cumulatively, according to EIA's oil market balance since the start of 2025, we are now missing 120 million barrels of bills. The tooth fairy must have taken it. Look at where we're at. This is total oil stocks, crude and products, drew by 7.1 million barrels last week. Where is the glut? Now, maybe the markets are trying to price in the forward-looking information. Maybe they've got it wrong. Maybe they don't. I think they've got it wrong, and that's also why I think we're going to get a slingshot way upward. Here's Crude Chronicles, and this is another thing to think about, and this might be something that they're looking at, the oil markets. Oil bros and broettes better hope these manufacturing capex intention surveys pick back up because these things are super low. But this could also be a potential bottom soon. So maybe the worst is behind us. Maybe people are cutting back on capex because of a variety of reasons in terms of the uncertainty, the tariffs, all sorts of stuff. But that's manufacturing capex. Manufacturing capex is going to deal with the tariffs, and we've seen a strong decline since that news was brought out. They are freezing capital expenditures. And this here correlates, the regional Fed manufacturing capex intention survey correlates with distillate fueled oil demand. Just an FYI. So we could see this drop down before going higher. So this is the bear case. The bear case is that we've got these tariffs on, and it's really gumming up the supply chain in terms of, well, it's not gumming it up, it's drying it out because people are canceling orders left and right, and they are reducing capex spend. Bob says there are increasing signs that the embargo by the new administration is starting to have real economic consequences. Container bookings have collapsed. Ports are seeing reduced activity. Trucking is decelerating, and retailers say in a few weeks store shelves will be empty. He's hitting the supply chain. I don't know if this is done on purpose or what the deal is here, but this is going to have a problem here, and I'm trying to find out, what exactly is going to get hit the most, because maybe I need to stock up on that. Whatever comes from China, I would say, and maybe other areas that still have tariffs on it, they're going to be impacted. So I think whenever we get through inventory, it could be a pretty negative outcome. We could see store shelves be empty. Here's another one from Kevin. He says, here's some ballpark analysis on why China will wait out the USA on a tariff war. Simply put, the trade war will hurt America much more than China. He used Grok, which is the AI in Twitter here, to try to get some reasonable approximations to demonstrate who really profits from the Chinese manufactured goods flowing to America. So this is kind of what the deal is here. So this is goods manufactured by U.S. companies in China, but this is the profit to American companies. 80% is going to American companies. Profit from Chinese companies is only 20%. Goods imported by U.S. retailers, 65% is the profit to American companies and 35% to Chinese companies. The goods imported by U.S. manufacturers, 55 profit to America, 45 to China. And then goods imported by Chinese companies, The profit to American companies is 0, but the profit to Chinese companies is 100%. So when you look at this, the goods that are imported to America and are goods imported by Chinese companies, the profit is 100% Chinese. But all the stuff that gets imported to the United States, there's a good chunk of profits, more than 50%, going to U.S. companies. So by using these tariffs, it's actually hurting the United States companies more than the Chinese companies, is what I think he's trying to show here. Freight futures AM update, dry bulk was flat for Capesize and down 3% for Panamax, and the tankers for VLCC and Suezmax are flat. Spencer says, if you think Americans are angry now, just wait another 14 days for shelves to begin being empty in Walmart. It's going to be absolutely a nightmare. So the CEO of 3 of the nation's biggest retailers, Walmart, Target, and Home Depot, privately warned him that his tariff and trade policy could disrupt supply chains, raise prices, and empty shelves, according to sources familiar with the meeting. The big box CEOs flat out told him, Trump, the prices aren't going up. They're steady right now, but they will go up. And this wasn't about food, but he was told that shelves will be empty by administration official familiar with the meeting told Axios. Another official briefed on the meeting said the CEOs told Trump disruptions could become noticeable in 2 weeks. Everyone's watching Bitcoin. I say watch silver, and this is looking like a potential bottom for silver versus Bitcoin, and then the potential breakout that's coming out into the future. I agree. I think physical metal. So here's my opinion on this, guys, and everyone knows I'm not a huge fan of Bitcoin. I'll tell you why. It's not about how the white papers are set up. It's not about the design of Bitcoin necessarily, even though I think there's a ton of flaws in it. I don't want a central bank digital currency system. I don't want to go to that. I don't want them to control a variety of things. I don't want them to wipe out accounts, put time limits on dollars in that wallet or whatever it is. I don't want them controlling. I don't want them to do social credit scores. I don't want them to lock up your account. I don't want any of that. Bitcoin is a gateway to that. And I feel like they are basically funneling the sheep into Bitcoin to gain trust in central bank digital currencies or cryptos to begin with that will eventually end up in CBDCs. So I think they're funneling the sheep to get everybody into it. Not only are they getting people to buy something that literally doesn't exist, intangible asset, so to speak, quote, but it also increases the confidence in crypto / CBDCs. So I think they're just trying to herd the sheep right at it so that they can implement whatever the heck they want to next. And it gains trust with cryptos and people using it to some degree. That's what worries me. I don't want that control in their power at all. And they're gonna link this up with artificial intelligence. It's gonna be absolutely horrible, I think. Here's OPEC plus game plan. Real spare capacity is far lower than you think. Rip the Band-Aid off now. Crude exports is declining. Yeah, huge. But we'll see what happens in the future. And this is something we're going to watch together here. Tavi says, the first thing that came to mind as I listened to BESSENT discuss the term trade rebalancing was the chart below. The most significant rotation still ahead of us is the rebalancing within the equity markets themselves, in my view. Often, in trying to correct one distortion, another one is set in motion. That dynamic may be unfolding here. A long-term weaker dollar coupled with capped yields is exactly the environment the rest of the world needs to begin outperforming U.S. equities. So if that occurs, what they're doing is they're transferring pressure in the bond market into the currency. And that's your long-term weaker dollar. That's the pressure building in the currency and blowing off that bond market pressure. So if they cap yields at, say, 4.5% or lower, That's going to support the stock market because whenever you get above about 5% in yields, that's when the stock market starts to sell off. So if he caps it at 4.5%, roughly speaking, he transfers the pressure to the dollar. The weaker dollar is going to be a problem. What it's going to do is it's going to price commodities way higher, and that's what it looks like it's going to happen here. Another one for Grady here, and this is another one that so all of these things that I'm going over are interconnected. That weaker dollar is going to push the Canadian index way up because of currency exchange rates. So it says the chart below means that a lifetime commodities opportunity is about to once again go into overdrive. The reason it's going into overdrive is this weaker dollar. The reason we're getting the weaker dollar is because BESSENT talked about that up there with that 4.5%. So that if they hold the interest rates at 4.5%, they transfer all the pressure to the currency. As that currency declines, your commodities that are priced in dollars rip. Gold's already priced that in. That's why gold had such a big move. Commodities are to come next. And then you're going to see emerging markets and other currencies outperform the dollar. So this ratio chart caught all previous big up moves, and now it's backtesting, preparing to launch. This chart also shows how historically undervalued small and mid-sized commodity companies are versus the commodity index, the CRB. Think, for example, GDXJ versus gold, SILJ versus silver, and URNJ versus SPUT. So this is bottoming and ready to turn higher. This is your buy point down here. We had a little false breakout there. Now, we have a ton of false breakouts occurring across the board. Oil's doing it right now. I think they're all buying opportunities. Why? Because I believe that the dollar is going to get weaker. I think that we're at the beginning of a commodity bull market. We have falling wedges across the board in a variety of different currencies, in a variety of different ratios that are supportive of certain sectors. And we also see this in a lot of emerging markets, a variety of them. And emerging markets are starting to turn higher and move on up. That's capital front running all this. So the market is telling me what it's doing by people positioning money in these things. So that's where my head's at. Watch what the Saudis do, not what they say. So watch this in terms of Saudi crude exports. If this doesn't go up, they're not producing more. They're just accounting for all the cheating in the system. Dan says Norway oil production is still tracking to down year over year, in line with Norway's Jan 9th forecast that it reached peak oil production. Expects a plateau production from 2023 to 2026. March oil production was down 4.7% year over year. This is going to occur in oil fields all around the world. They are occurring, a lot of them have occurred and will occur right around the 2020s. We saw conventional oil peak in 1970 for the United States. Shale's about to peak in 2020 something. I think we're peaking right now, and we'll probably plateau for a couple of years. And then you're going to have all these other small production areas start to peak and plateau as well. We are going to need copious amounts of oil coming up in about 5 or 10 years. And I mean, it's going to be ridiculous. I don't know where it's going to come from. Historically, you could say, well, we've got this shale, we just don't know how to extract it. Well, now that we know how to extract it, where's the oil fields that we've got that have copious amounts of oil? Big question mark. And how easy is it to get out? Maybe we can find some new technology and get out some more. Maybe not. We'll see. Oil falling hard on descent within OPEC. But the more important metric to follow is the crack spread, because that is the best real-time gauge of demand. And for now, that crack spread is holding up. Crack spread is the spread between gasoline and oil. It's the refiner's margins. As long as the margins are high, it means that you've got pull demand is what that is. So demand is pulling that demand is pulling gasoline prices higher and keeps pulling and pulling and pulling, and that is the supply demand of gasoline. So your crack spread is big when oil goes down, but yet the gasoline demand is high. Tracy says, I challenge anyone to find an oil glut so far this year. The IEA predicts an oil glut. Demand will grow by 700,000 barrels a day this year and next. Non-OPEC supply alone will add 1.3 million barrels a day in 2025. These additional flows could nearly cover all new global demand. And that's where people, I think, are worried. So then what we need to do is we need to look at the inventory levels to see if they build. That's what's next. Christopher Aaron says there's nothing more bullish than a false breakdown. Silver is attempting to solidify its trend recovery now, which will lead to a surge above $35 within the coming months. Yeah, if we get above 35, it's going to be very bullish for silver. Here's another one from Kevin. He says, moreover, SPUT can set spot prices at $100+ a pound. When it gets inflows again, and the stocks will all be up 100%. This is how the uranium sector will ebb and flow. Price action creates optimism, creates capital flows, which creates price action, which creates flow. Convexity at work. Remember how totally bullish everyone was last fall when the tech companies were announcing their move into nuclear power? What happened? Market fell apart because outflows led to selling, led to SPUT falling, led to selling, led to pessimism, led to tears, led to uranium accounts going into hibernation depression. In his opinion, the turn is on. Grifter's going to grift, says Kevin, and it says breaking. President Trump's meme coin, Trump, surges as much as 65% after he announces that the top 220 holders will get to have dinner with him. Grifter's going to grift. Look what's happening in California. Its unemployment rate peaked and is headed lower. This also happened in 1980, 83, 93, 2003, 2010, and 2020. Every single one of those inflection points sent the U.S. unemployment rate lower. This is the opposite of the prevailing narrative. So we actually have unemployment dropping in California versus going up. And I know a lot of people are positioned for a recession. Maybe it has something to do with all that liquidity coming into the system. Who knows? Julianne, okay, I already went over that. So that's where we're going to end it, guys. That's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. And we'll see you guys on Saturday at 7 a.m. Mountain Time for the Q&A session. Don't forget to put in that special coupon code if you'd like to sign up. And don't forget that we are going to be covering my approach to selecting what are, quote, they ask what the best companies are in each sector. Obviously, there's no best. There are certain vehicles for certain people, and we can go over that, my approach on how I look and find companies. All right, guys, we'll catch you next time. This is Finding Value.